Hello and welcome to Bloomberg Quint Live, and you are watching Trend Spotting. I'm Neeraj Shah. In the next 30 minutes, we deep dive into specific trends in the market to draw out the key takeaways and implications for investors. First, the headlines. Markets continue to trade under pressure as both the benchmark indices trading with cuts. The Nifty trades below the 10,400 mark. Broader markets outperform. The Indian government is mulling barring 91 willful defaulters from leaving the country. That is a Bloomberg exclusive. Fertilizer shares trade with gains after the government extends urea subsidy and implements the direct benefit transfers for disbursements of the fertilizer subsidy across the country. And the Dalmia Bharat Bain Capital and Piramal combine is said to have Binani Cement's creditors' support to buy the company. First, a check on what the markets are doing today. Yes, precious little, you would say, because the large caps are underperforming. Just bring up the index about 1/3% down, and the index gainers and the losers lists, and then the broader end of the spectrum, the advanced decline ratio, will show you the mood of the market. Firstly, the Nifty losers. IOCs, a technical correction, so don't quite look at it fundamentally. But banks have come off a bit in the session today. Private banks, which surged in trade yesterday, are sold off. ICICI Bank and Yes Bank coming off. Ultratech loses out on the bid, arguably loses out on the bid. We learned that the lenders have given their support to Dalmia Bharat, as the headline stated, and Ultratech is down about 1%. And then some other stocks, tiny tunes, losing out a little bit in trade. On the flip side, the Nifty 50 gainers will come up on your screen. And again, very minute gains, no strong moves. But for the fact that Bajaj Finance seems to have found its bottom, and the last few sessions has been doing rather well for itself. The real activity is at the broader end of the spectrum, wherein the fertilizer names seem to be the ones which are in the driver's seat, and then the PSUs seem to be in the driver's seat. So first, Chambal, Madras Fertilizers, National Fertilizers are all having a good day. Coromandel up about 3% too. So look at that, the set of stocks and the moves thereof. Fairly good moves and fairly decent volumes. And then the PSU lot, ITDC, MMTC, Hindustan Copper, Shipping Corporation. This set of names have some really strong moves themselves in the session today, so do watch out for them. Last but not the least, I do want to mark J Corp. Yesterday it had a really large move, 10-11% up, and in today's session follows up with another 7.5% move on 4.5 million shares traded. I don't know if this got to do with some more developments around the Navi Mumbai airport region or something else, but it's very difficult to call why is it that J Corp would be doing what it is doing on any given day. It's up about 7.5 or 8% today. However, that's the market for you. The market breadth, a lot better than what the benchmark index rate would be showing. But let me tell you what's happening on Trend Spotting today. We'll discuss the outlook on markets, valuations and capital markets with Subramanian of Axis Capital. We decode Galaxy Surfactants first earnings post-listing with the Managing Director Unnathan Shekhar, and we discuss Jagran Prakashan's growth prospects with the CFO, Mr. R.K. Agarwal. Firstly, the Indian auto sector is at a peculiar spot, and with the challenges and opportunities in the mega BS6 emission and safety norms, the spotlight is also on the government's push for electric vehicles. These uncertainties provide a good opportunity to back the biggest winners in the sector. That's the main backdrop for Axis Capital's 4th annual auto conference. And to talk about all of this, market outlook and valuations, joining us is now Mr. S. Subramanian, Managing Director and Head of Institutional Equities at Axis Capital, and Jayesh from our research team Johnson to take the conversation forward. Jayesh, over to you.
Good morning, Mr. Subramanian. First question to you is that the conference timing is very interesting, given that the global markets have recovered from their low point, but the India market has struggled. So what is the mood of the participants at the conference?
I think that the mood of the participants is quite positive. They are here to understand from the companies in the auto conference as to what's happening to the economy. It's also, as you know, auto is the lead indicator for the consumer sector, and therefore in this conference they would be meeting about 15 companies, from OEMs to auto components to financiers as well as dealers, so they get a cross-section view of what's happening in the economy. So at this point in time, the mood of both the companies which are presenting as well as the investors is quite positive.
And what have you made of the valuations in India, given that Nifty is currently trading at 21 times forward earnings?
See, our view essentially is that according to our research, Nifty, the way we look at it is to March 2020 numbers and a March 2020 numbers. It's broadly in the region of about 17 and a half numbers. It is, while it is towards the top end of a long-term average, it is not in the bubble zone. The question to ask about the valuations as far as the market's concerned is what's going to happen to interest rates. Our quick straw poll, which we did with a lot of treasury heads and bond fund managers, tells us that they do not expect interest rates to spike from here. How long will it take for it to subside from here is a different question, but I don't expect anyone is expecting that the interest rates to go up from here. If the earnings momentum continues as to what we are seeing in the fourth quarter, as well as into the next year, I think that we would be looking at the markets being valuations wise. You could see some PE compression, but the PE compression need not come through a fall in prices. The PE compression can come through a expanded earnings as well.
Now, oil prices have rallied and stabilized above the 60 mark. How much do you think this will impact India going forward?
Oil prices is an important element for Indian current account deficit as well as for inflation. But I think that overall prognosis for most of the people, if I look at Platts year forward, I think that most of the expectation is that oil should stabilize between $55 to $60. If that is the case, I think that RBI expectations of an inflation to be in the 4 to 5% range should come through. So it has got more of an impact on current account deficit and not so much on inflation if the oil continues to stabilize between $55 to $60.
Now the primary market activity has been on a high in recent times. What have you made of the primary market pipeline, and do you like any of the upcoming IPOs?
The pipeline is very good. It tells us two things. One is that as long as a company is coming in, a good quality company at reasonable valuations, you would see significant market participation. We are right now in the midst of, today is the opening for Bandhan Bank. Yesterday the IPO anchor book got done. As you would see from the announcement, there were 65 investors who had come in, pretty large number of very high quality investors in the book. We think that that's an outstanding issue. We would see significant institutional participation going ahead. Even in the IPO itself, it starts today and closes on Monday. There's also another outstanding company which is presenting, which is the Government of India's Hindustan Aeronautics Limited, which is also coming out. Excellent issues which are there. Another good quality company from our stable is Sandhar, a auto component company, which is also seen a significant investor interest. The anchor book for that is tomorrow, and we will be able to see what kind of a demand that's been able to gather. But overall, I think that the IPO pipeline is good, healthy. I think that as long as the companies are able to price their issues reasonably, I think investors are looking forward to participate in Indian companies.
Now, talking about sectors, the IT sector has made a comeback in 2018 with the Nifty IT index being the only sectoral gainer. Do you think there is more room for upside?
If you really look at IT, and you said it right, they have made a good comeback in the current year. It's also off extremely debilitating 2017, which they saw. My IT analyst is very bullish on the sector. He's looking at double-digit growth for the leaders. And if you're seeing double-digit growth come through, these companies will still see upsides in the region of 11 to 15%, depending upon which company you're looking at it. Therefore, we still are very positive about the companies in the sector. We think that if the global interest rate scenario does what it is, the rupee, which has been very, very strong, if rupee stays even stable at around 65 to 66 level, should be another positive thing for the IT industry. The third element essentially is that Indian industry gets nearly 40% of its revenues from the BFSI sector. We are seeing global BFSI giants like JP Morgan and others starting to spend once again on IT, and we think that and the digitization push is continuing. Indian IT vendors would be beneficiaries of those upticks as well. So I think that overall that the Indian IT industry upside is not yet over, and I think that the good times are still there.
Well, one final question then. Any of the other sectors that you think are currently attractive, or something that you would avoid at the moment?
We need to look at individually company to company. Broadly, I think that we would be able to find gems in most of the places. The only area which I have interesting to note essentially is that the consumer staples, while they will continue to do well, and if the monsoons are good, will continue to do well, are reasonably attractively, expensively priced. That's the only sector in terms of a price performance I would worry about, not in terms of the underlying fundamentals. But other sectors you need to look at bottom-up, stock-specific rather than a broad sector brush.
Well, thank you so much, Mr. Subramanian, for taking the time out and speaking with Bloomberg Quint. Wish you all the best for the conference. Neeraj, over to you.
Well, thanks a lot for that. That's an interesting set of thoughts that Axis has given. And remember, during the course of the day, we'll have many such conversations with the Axis Capital team as well. Okay, on to some specific companies and specific conversations. Galaxy Surfactants has reported the first set of earnings post its debut on the bourses, with the specialty products providing higher margins. What kind of growth can we expect going forward? To answer this and to shed some light on the company's quarterly numbers, joining us on the show is Managing Director, Mr. Unnathan Shekhar. Good having you, sir. Thanks so much for taking the time out. Now, I do have your Q3 numbers, where revenue is about 600 crores. Margins at about 12.5 and a profit of 41 crores. I don't have the corresponding numbers. Would you be able to tell us what's the kind of growth that you've shown in the quarter?
We have in the last quarter, of course, grown more significantly compared to the last quarter of year 2016, because in any case this comparison is not very significant or very material, because the last quarter of 2016 was a demonetization quarter. Okay, so that should not be, this should not be taken as a normal growth that we have that we could expect. So, but we have grown pretty well as far as this quarter is concerned. Year on year, as far as this year, for the first 9 months, I think we have grown on volumes by approximately 10.5%. Yeah.
Mm-hmm. And does it look like the 10.5% mark will sustain in quarter 4, or can you better it in quarter 4?
I think we have a very steady business going on, and I think we should be able to maintain the growth momentum as we have seen in this year. So we should be able to maintain it.
In which case, I'm just trying to get a sense of the numbers first before we get into how business is looking, Mr. Shekhar. FY17, I believe you did a top line of about 2160 crores. I gather that you've done in and around that 1800 crore mark in the first 9 months. Are you on track to show about a 10 to 15% revenue growth as well in FY18 over FY17?
We should be able to maintain our performance. I think whatever we have done in this year, we should be able to maintain and be consistent.
Okay. How is the operational picture looking like? Your margins at 12.5%, I can understand that revenue can't be compared because Demon was a base and therefore so on and so forth. But your EBITDA margins, they've stayed steady at this about 12% mark. I believe for the first half it was 12% too.
Yeah, they would stay steady around this number, give or take a few points, or decimal points, above or below. So that's how it is.
But I'm wondering, I mean, what's the quantum of revenue that is coming in from specialty products? What's the game plan of taking them higher, if there is a game plan out there? And does that provide a natural tailwind to your margin performance over the course of the year?
See, as you see, the performance surfactants are basic building blocks of any growing market. So our performance surfactants also will continue to grow. So we need to look at growth in both the segments, both performance surfactants as well as specialty ingredients.
So okay. Does the ratio stay similar to what it is right now between surfactants and
more or less similar, because so, performance surfactants will continue to grow. Okay. As we grow in even in India, there is a huge headroom for growth available in terms of performance surfactants. So we will continue to grow there.
Okay, so there is no conscious effort by you as a company to grow the high margin business more than the slightly lower margin business.
No, we are in this personal home care industry, and it is important that we grow across all the categories. Okay, it's not that we can grow only in one particular category or sector, because we wouldn't then be doing justice to the other categories. We should grow it all across the board.
Okay. Would you, I mean, I'm guessing by looking at your capacity utilization levels that there is enough room to increase capacity utilization at the existing plants in India, because you were probably at 60 to 65% consolidated. What do you think happens over the course of the next 12 to 18 odd months? Where do capacity utilization levels move up to?
See, kindly note that when we talk about this capacity utilization, this is an average capacity utilization across all plants and across all categories. So there could be some particular plants where the capacity utilization will be pretty high. And there we would take anticipatory action in terms of either debottlenecking the capacity or increasing the capacity. Of course, as we have mentioned before, all the capacity expansions that we would do now are all brownfield expansions. Okay? So we do see opportunities for debottlenecking in all our in some of our plants, and we will continue to do that.
No, I was actually trying to gauge or get a sense from you, sir, that for the future, the next 2 or 3 years, it seems like growth can come for you if there is demand without any capex that you would need to undertake.
No significant capex. Okay, but we may have to, tune some of the plants to get more, productivity. As I said, not everywhere the average capacity utilization is low. Okay, there are some plants where the capacity utilization may be upwards of 90%. Okay. Yeah.
Okay. Yeah. What about customers? I mean, every packaging company or a chemical company which has got some of the top clients as their customers, I tend to ask them about, have they added newer Fortune 500 companies into their customer base over the last 6 months, and are they mining more business out of the existing ones? How is that picture looking like?
No, we continue to add customers across various geographies.
Yes.
And we continue to grow with our existing customers. See, our strategy has always been to grow with existing customers, increase the value share by cross-selling various products, then adding new customers, small customers across various geographies. And then when we talk about adding more and more value to our existing customers, that is through innovation. We continue our focus on innovation, coming up with new products, introducing new products to both existing as well as new customers. And further, we again focus on both the geographies, both the emerging economies as well as the mature economies.
Which is good to know. So FY18, sir, I get a sense of the kind of growth that you're talking about. Would FY19 be that steady state 10-15% revenue growth number?
Yeah, we will continue to grow at higher than the market. I mean, this is what we have been doing. So as the market, all the specific geographies that we focus in or are in, we do grow higher than those economies in terms of the growth rate.
And it's difficult to gauge growth rates for a company, sir, let alone the market at large. So what to your mind would be the growth number when you say that you will grow higher than the market?
See, let us say as far as India is concerned, India has been growing and is slated to grow at about 7.75 to 8% as far as the personal home care industry is concerned. So we will grow at higher than that rate. So I did talk to you about the growth rate that we have done in the last year. That should tell you where we will be and where, what sort of growth rate that we would be at. So the Indian market has been growing at about 7.75 to 8%.
Okay, yeah. We wish you all the best for that steady state growth. Mr. Shekhar, thank you so much for taking the time out and speaking with us, and all the best. That's Galaxy Surfactants, steady state 10-12% growth. They believe they'll grow better than the market, which they have been doing for the while past now. And I was just looking at what they've done for 9 months as well. It's just exactly that steady state performance that they've done all through these years as well. So no dramatic uptick. They don't believe margins will dramatically improve. They are not looking to increase the share of specialty chemicals in such a meaningful way that margins move up from this 12% to 14-15 odd %. So all of that steady state. And as you can see the pie charts as well, I don't think they've really changed the mix too much. They've been growing at the 10-15%, and the share between surfactants and specialty chemicals also continues to remain the same. Okay, on to other newsmakers. This was a results-based interview. Now let's get in Jagran Prakashan. Their December quarter earnings may have been a bit off, but really don't look at a media company from what they've done in a quarter. Largely over a year, what is the kind of growth rate that comes about is the question that we ask most media guys. Motilal Oswal, of course, has come out with a report. They believe that the company is on a cusp of a revival as well. So let's talk about the growth prospects for the company and get in Mr. R.K. Agarwal, who joins us on the phone line to talk about all of this and more. Mr. Agarwal, good having you. Thanks so much for joining in. December may have been what it is. Is the current quarter looking like getting back to steady state growth?
Before I talk about the whole of the quarter, let us look at various businesses of our company, right? So they have, each business has different color, and what I would request you, to look at them, and then reach the conclusion. Okay?
Yes.
And so as far as radio business is concerned, since November, it has been growing, on the expected line at a very steady rate of growth of nearly, between 15 to 20%. Hello?
Yes. Yes, I can hear you, sir.
Yeah, and in fact, new stations which were launched, they have done far better than what we had expected. Number 3, as a result of that, we, I think, will deliver, better operating margins than what we had envisaged.
Okay.
For whole of the year.
That is for the radio business or for the overall business?
That is for the radio business.
Okay. What would those numbers be, sir? And then we'll move on to the other businesses.
Number in what sense? As I said, operating margins are going to be better than what we had envisaged or what we had indicated at the time of our, going to market in the month of January or February last year. So we were expecting, the current year's operating margin in the range of 30%, which I'm sure, would be better than that.
Okay, fair call. So that's the radio business.
So, yeah, that's a radio business, and most heartening things are two. One is new stations doing far better than what we had envisaged. We'll be breaking even, far earlier than what we had envisaged. Number 2 is a very steady rate of growth since November till March. So radio, clearly we see, the recovery already taking place. Now coming to, digital business for us has been growing exceeding, 20% throughout the year, and that is what would be the growth rate for the year as against, our peers who have shown degrowth. So digital business is also doing very well. Outdoor and event businesses, they have done exceptionally well, especially outdoor. So they will continue to do very well in fourth quarter. Now coming to the largest business, which is the print. there, in our case, we had benefit coming from the UP elections last year, which is not there. So that, in fact, increased the base and neutralized a bit the demonetization impact. So I do not see any growth coming in Q4, but most importantly, if we exclude the election benefits and the revenues from the government, right, which were on account of UP elections, then private sector has done pretty well. And those private sector has done pretty well, and that is what is on recovery mode.
So FY19, Mr. Agarwal, if indeed the private sector spending continues to remain robust and we hit the election season in a meaningful way over the next 12 months, can we expect that the overall revenue pie will look a lot better than what it than the 10% odd expectation that people have?
Of course, I fully agree with that. I mean, like, as I mentioned, all the businesses will have different growth trajectory, but on overall basis, if we grow, 9 to 10% next year, especially at the back of, general elections, which are due in 1920, right? So we remain very optimistic about it.
More than 10%. And one last question, sir. I mean, the belief that people have, I mean, reading out a brokerage, while they believe that there'll be a 10% CAGR, and I think the number that you mentioned could well be, I mean, there is a possibility that it could well be higher, but they believe that your EBITDA would grow maybe anywhere between 15 to 20% over the course of the year as well.
I do agree. I mean, let me correct, as I mentioned, different businesses will have a different, growth trajectories, and on overall basis, I do not say beyond 10%, but I say, revenue should grow in the range of about 9 to 10% overall, revenues, and that should result in EBITDA growth of 15 to 20%. There is no doubt about it.
Great. Just wanted this reiteration. We're out of time completely on this show, Mr. Agarwal, but thank you so much for taking the time out and being with us today.
Thank you.
That's the view from Jagran Prakashan. But with that, it's a wrap on this edition of Trend Spotting. Up next is Hot Money. Stay tuned to Bloomberg Quint Live.